Hi, this is Dan Collins, Editor-in-Chief of Modern Trader Magazine, coming to you live from the floor of CME Group on Friday, December 4th for Traders Exclusive. Well, today we got what most people would believe is final confirmation that the Fed on its next meeting in December will raise interest rates 0.25%. The November jobs report came out today, very positive. Non-farm payrolls were up 211,000. And most people thought that that was the last element, that they assumed that the rate increase would come in December, but if an outlier jobs number came in, that might cause some problems. So, you know, I'd hate to speculate on what could prevent them to do it now with what's going on in the world. So it looks like they're doing it, which will be good for the markets. People have been looking for certainty. They've been looking for the Fed to begin this, and then people will have their plan out. But for those folks that think that they've been, that this is going to provide some relief with higher interest rates, that may be not the case, and they may be disappointed. There may be some buy the rumor, sell the fact activity going on, and there's some cold reality that we have to kind of discuss. Even though the Fed fund futures aren't a crystal ball, but it tells you where the market thinks. So I was looking at those numbers today, and if you recall, the last 2 to 3 years, the Fed had been targeting 2015. At some point, it was the middle of the year that was targeted. Numbers became soft. It was pushed out. People thought it would come in September. We had a couple bad numbers, and we had some geopolitical risk. We had the problems with China and Europe that pushed that further back into December. But if you look at the December 2016 Fed fund futures, a year ago, because right now, if you look at December 2016, the Fed funds are at 99 and about a quarter, which means that they're expecting 25 basis point increases next year. Now, a year ago, the assumption was that they'd raise interest rates about 100 basis points a year once they began. And that was conservative. You remember the last tightening cycle, it was every meeting for 2.5 years. So that's 2 full points, 200 basis points a year. So that was a pretty conservative estimate. That has come down. If you look at the Modern Trader, the January Modern Trader magazine that just came out in my futures column, we show a graph of the January 16, January 17, and July 18 Fed fund futures to see where this is priced out. So right now, these are priced out for 50 basis points in 2016, maybe 2 to 3 25 basis point increases in 2017. That's a very, very slow, moderate pace. You know, people are depending on interest income are not going to get a whole lot from that. You look at the December 2016 contract, and this is what I want people to think about in their trading and how things have changed and how the outlook on the market has changed. So a year ago, you're looking out what would be 2 years in the future. They had the Fed funds rate for December 2016 at 98 and a quarter, basically. So by a year from now, they would be at like 1 3/4%. Now, a year from now, it's at 99 and a quarter. So they're only expecting the Fed funds rate to be somewhere between 75 and 100 basis points a year from now. And that's assuming it's going to be at 37 basis points a week and a half from now. And to get to that 1 3/4 points, you have to go all the way out into the July 2018 contract. So compare where we are today as expectations and as economy as to where we were a year ago. A year ago, we thought rates would be at 1 3/4, still extremely accommodative by next year. That point doesn't occur now based on the Fed fund futures until mid-2018. That's a pretty, now it can change. Numbers improve, inflation numbers pick up. They'll certainly speed up the rate of tightening. But I think, everyone in their portfolio and their bond trading and in their outlook on the economy has to kind of look at that, because that's a pretty interesting statistic. Where we thought we would be a year from now, a year ago, won't happen until July of 2018. So that's 18 months delay. That's the economy is worse by 18 months, if you want to even put it. That's where we are today. So it's great that I think the market will get some certainty from today's number, and the Fed will move on December 16th. But the entire outlook on where the economy is going has shifted dramatically in the last year. And I think that it will have an impact on portfolios. It will have an impact on your trading. It will have an impact on, everything, I think. So this has been Dan Collins, Editor-in-Chief of Modern Trader Magazine. Our July issue is out. It'll be online in a couple of weeks. Go look at it. Talk to you next time.